mile to get inflation back to where they want it to be, around 2%, and how this is going and how long we need for that. I will discuss that as well now with the governor of the Central Bank of Lithuania, Mr. Šimkus. Thank you very much for joining us.
Thank you for having me here.
We were just saying that inflation has dropped pretty much in line with consensus across the euro area. We're not yet there where you want to be, but is it now time to actually keep on cutting rates, because there's also a time lag when it comes to monetary policy action?
Well, what we definitely know that the last mile or kilometer here in Europe is going to be bumpy and difficult. And we had an increase in May of inflation. Now it dropped a little bit, and we had information on wages, which is compensation for employees, for example, increased a little bit in the first quarter. Economics, it improved, but it's still subdued. So all this makes like a mixture which is also quite uncertain. Therefore, when I talk and I see the cuts, so it's not the cuts itself that are important, but whether it leads to the 2% target in the medium term. So we've cut in June. Now the question was about July, but here I should say we are not in a rush. We should get more information, we should have better understanding, but still, if the economy and inflation within it moves along the projections or the way I see it, then I think the further cuts should be on the table.
Yeah, so we talk more about September when we also got a new round of staff projections. Is that the time you look at?
Yes, more or less September and months later on, because the important factor or the important thing, it's not only headline inflation. As I said, we know it's going to be bumpy, and most likely we will end this year with inflation around 2.5 this year. But for me, the major thing or the most important thing, this is the core inflation. Does it, so to say, got the downward trend? Compensation for employees and all other information from the labor market, has it got the downward trend? And then from that, or like with set information, you can make further judgments for cutting.
What I think is interesting is that inflation did shoot up very quickly, so that was new for policymakers in the euro area. But could we also look into a scenario where inflation actually goes down more quickly than anticipated? What is your view?
Well, there are many what-if scenarios.
Yeah, of course.
And what we learned, we need to be more humble in a way we project or foresee the economics development. But the best we have now, and I mean not only the ECB, but the IMF, the economic commissions, all market economists. So like the general agreement is that we are not undershooting 2% target, like substantially, considerably undershooting 2% target, let's say 2026. But as I said, we need to be humble. You know, it's 2 years ahead, but like this general common sense says us that we'll be close to 2% target by the end in 2026, and we'll reach annual inflation of 2% by the end of 2025.
Let's look also at your country. It's of course a very tiny country, but you had really very high inflation, like more than 15%, if I could remember that. More than 20, even more than 20. Now you're down to like 1%, you just told me. How could that happen in such a short time span?
Well, first of all, we are still like converging to the average EU level countries. So typically we have a little bit higher than 2% inflation in Lithuania in normal times. So this is one thing. The second thing is that I like the word compact and very open economy. So for instance, energy shocks were transmitted much more quicker and stronger to my country, because we price so to say the energy basically the same as in spot market. So this is next thing. The second thing. The third thing, that I think there was a little bit of the overshooting in repricing of companies, you know, products and services in the years of 22, 23, where we had this peak of inflation. And now this overshooting is somehow compensated with a little bit lower inflation this time.
Do you see that this is what we are also seeing perhaps across the euro area, that there's less perhaps economic power to pass on higher costs, so that prices in the end for the end consumer will not go up anymore?
Well, to some extent I agree that now for companies it's a little bit harder to pass, as I said, the increase in costs onto the final prices of goods and services. But here I need to admit that the increase of unit profits were one of the reasons why we've seen inflation quite strong in years of 22-23. So this is one thing. And I would say if the ability of the businesses to pass through the increase of costs into final goods, into final prices of goods and services would increase, that would be inflationary risk. So I would expect that it keeps to be as it is now.
How are your discussions with your colleagues concerning the stability of the European bond market, given that we recently have seen wobbles within the French market, and that there is, of course, also a risk of a spillover? So how's like the sense of urgency there?
Well, if you mean the current election process in France and the increase in spreads of French bonds, and then you kind of refer with the word urgency to that situation. So I don't think this is in a way urgent situation, because it's not unwarranted or disorderly development in what I see in the markets. And I think the monetary policy of the euro area is smoothly and efficiently transmitted to every single euro area country. So this is one thing. But the other thing, that elections are always a little bit with uncertainty, because people go to the ballot boxes and they vote, and it's democratic process, whether it's in France or it's in Lithuania or in any other euro area or European Union country.
It's a democratic process, but that democratic process currently is telling us that perhaps something needs to change, and that perhaps like communication or whatever needs to change. What is it in your view?
To change what? Sorry.
To get people back in the boat of the European project, more integration. That's what policymakers are discussing is much needed, but it doesn't seem to like be the appetite of people who are going to the polls.
Well, I think what's important here that we do have single monetary policy in the euro area, but to have it efficient, it's very important that we also, as countries, stick to the European fiscal rules, that we have new framework for that. The second is that yes, what needs to be admitted, that we have not only the geographical fragmentation all across around the world, but it's also like inclination to more inward-looking policies within the countries. But we shouldn't forget that the strength that we have now as a union, it comes from the single market. So we shouldn't forget this, and I would say we should invest more into this singleness rather than to the other side.
Yeah, let's look into the crystal ball when we sit here and come together again in a year's time. Where are the interest rates?
In 1 year from now? Well, I'm optimist. Careful, but still optimist. I would say they're going to be definitely lower than we have now.
Okay.
I know that you want to ask by how much, but I believe it's going to be lower than we have cut in June.
So hopefully we have a bit more rate cuts to come until next year.
I do think so. Exactly. I do think so. If everything goes along, I see the economic development, there are no surprises. I see that even this year, I mean, I couldn't say that there's no chances for cuts like 2 times this year already. So basically, I agree with the market's estimates.
Thank you so much for your time, and have a good time.